This is the CRE Weekly Digest by LightBox, a firm transforming the commercial real estate landscape by connecting every step of the CRE process with comprehensive tools and data. I'm Martha Kocher with our experts Manus Clancy and Dianne Crocker. For the week of September 30th to October 4th, with economic data released showing hopeful soft landing signs, the service economy grew at the fastest pace in September since early 2023. For now, the labor market is experiencing low hiring and firing. And as Fed Chair Powell said this week, the U.S. economy is in solid shape, and the Fed intends to keep it that way. But some new events may change that. The devastation from Hurricane Helene, the East and Gulf port strike now on day 3, and the escalating conflict in the Middle East. Manus, we're watching closely the job number that's going to be released tomorrow, but inflation could take a big step back with some of these macro events.
That's certainly true. There's no doubt that people were watching geopolitical events this week. They're watching the port strike, which began a couple days ago, and each of those could be very disruptive to the market. Let's face it, the CRE market has had some modest tailwinds coming to help it out for the last couple months. Treasury yields have dropped considerably. Fed 50 basis point rate cut was very helpful psychologically. We've seen transactions pick up. Enthusiasm for the market has started to replace some of the doom and gloom that we saw for 24 months. So there's been a lot of reasons to be cautiously optimistic since about May for the CRE market. For the first time in about 90 days, we're looking at a couple of things which could derail some of that enthusiasm. Certainly the war in the Middle East sent oil prices higher. That will have an inflationary impact, to be sure, if that extends for any period of time. Treasury yields have moved higher this week as people are expecting some kind of impact from the higher oil prices and from the strike at the East Coast ports. And should this strike go on for a long period of time, should supply chains get jammed, should this go on for a month or two, you can expect everything to cost more in late October and in November. And none of that is good for the markets. We've been very happy to see the market start to see some positive signs. This would be a step back if those things ended up being prolonged for more than a couple of days.
And we're going to eventually get to our September activity index around commercial real estate activity. But I'm going to take a minute first because, Manus, you were in the path of the hurricane and you're actually impacted by what happened the last week.
So yes, we are doing a remote podcast today from Clemson University. There's good and bad happening right now, and I'll start with the bad. Where I am, I would call the inconveniences quite minor. We have no power. It's been about a week. We'll have no power probably for another week or two. But all things considered, that's kind of like I said, a modest inconvenience. But you go 30 or 40 miles north into Asheville, and it's really a disaster. Lots of casualties, lots of people unaccounted for. The city of Asheville is kind of like an island right now. People can't get in or out. Water has to be boiled. There's no clean drinking water. There's no energy, meaning gas to power up generators. There's no electricity going through, and people are running out of food. So it's not an easily accessed area. It's not an area where they expect things like this to happen. So preparedness tends to be a little bit less than perhaps on the east or west coast of Florida. So it is a real American disaster that you're seeing in Asheville right now. That's the negative, and our thoughts are with those people. The positive I would point out here is that people in this area are just extraordinary. Getting up in the morning, that have personal chainsaws going out, clearing highways, making their homes or businesses open to people to work, to have a hot meal, to get a shower. Clemson University has been extraordinary in their generosity on all fronts thus far. And one thing I will point out that sometimes people tend to look at moments like this and say people are using this to exploit other people, that they're price gouging or they're driving prices higher or they're hoarding food or other things. I have to say, in the 7 days I've been down in this area since the hurricane, I must weave past, I don't know, maybe 10 gas stations anytime I come here to Clemson to do things. And I don't think a single proprietor has raised their price even a dime on gasoline, even as supplies are limited and some gas stations are running out of fuel. So the pain is really bad in Western North Carolina, but we're seeing some really terrific acts of kindness, generosity, and it's beautiful to see, honestly.
Well, I'm glad you're safe, Manus. I don't like that you have that firsthand view for us into the hurricane's impact. These crises always have a way of bringing out the best in people. So that's actually great to hear. And hopefully there'll be more help on the way for everybody affected by that. I did reach out to Holly Niebuhr. She is the CEO of AEI Consultants. They're a leading environmental due diligence consulting firm. They do a lot of work on energy efficiency assessments and building resilience. I will add too, Manus and Martha, she may very well be our biggest podcast fan. Because she's doing a lot of work on the building resiliency side, I reached out to her. She said events like this really bring the impacts of extreme storms into focus. You know, owners and lenders are being affected by higher property insurance rates. And those are just going to continue to rise as we see more of these $1 billion plus loss events. And then, you know, what Holly said is you've got insurance rates that impact property value, and then those costs start to affect the NOI and may affect property value upon exit. So I think little by little, the business reality is that climate risk is becoming a more visible financial risk for commercial real estate, and that more investors and lenders will be looking at this during their underwriting in the wake of storms of Helene's magnitude. Holly Niebuhr is leading the charge to write a new ASTM standard that was recently approved, and it's specifically to help commercial real estate stakeholders with these issues. It's called the Property Resilience Assessment Standard. These types of studies are being done alongside Phase 1 environmental site assessments and property condition assessments. And the focus is to identify during due diligence any hazards that may impact a property, identifying how vulnerable a site might be to those hazards, just like the flooding that you saw in your area with this storm and in North Carolina, Manus. So the hope is that Holly's standard brings some consistency to the wide range of climate risk evaluations that are already being done before commercial property deal making, and that it will incentivize investment in proactive resiliency measures. So if you're not familiar with it, it's worth a look. And lastly, I wanted to mention that Holly has generously offered to do a podcast with our sister production on the environmental due diligence side. So our LightBox colleague, Alan Agadoni, will be interviewing Holly later this month. So watch for that.
I did want to point out that the severity of the storm is one that we haven't seen for some time. There were 6 states affected. Some of the estimates that we're seeing, I think I saw an article in one of the Axios publications. Gallagher Re, which is a reinsurance company, has the damage estimates right now at about $35 billion. And of course, we'll see that number shift as they do more due diligence. And one of the things they pointed out was that in some cases, a number of owners may not have had flood insurance in this region. And to your point, Manus, this was not an area, when you're talking about Asheville, that was historically in the path of a hurricane. It's about 2,000 feet above sea level. It's several hundred miles from an ocean. It is in the middle of a number of waterways like rivers, but it is in a mountain area. So it is surprising to see the severity of the storm there.
I think that's right. I think that insurance will be an issue. When I was reading the history of that area, they haven't seen a storm like this in about 120 years, something like this. And I think the real issue was, to your point, the rivers just breaching from the sheer amount of rain. Maybe this is too much detail, but in the 3 or 4 days before the hurricane winds and storm came through, the region had had about 5 or 6 inches of rain from a different storm. So the rivers were already high before the hurricane rains came in. I think by the end, they were talking somewhere between 18 and 24 inches of rain over a 3-day stretch, and that just caused the rivers to breach. But it is, to your point, nobody expected people to need flood insurance in that region. And I think people will find out, sadly, that there are certain aspects of this storm that may not be insured.
Turning to our Lightbox data dive, it is the release of our CRE Activity Index for September. And we talked about this a couple of weeks ago. I think Manus made a bet of what the number would end up being. And I think Manus might be a winner. So Dianne, why don't you walk us through where we are with the September number?
September ended on Monday. We ran the September activity index numbers on Tuesday. Before I give the number, I looked up the numbers to beat. August was 89.9 and last September was 87.9. So September came in at 98.2. This is our aggregate index of activity in terms of property listings, appraisals, and environmental due diligence. So in September, that index was 98.2. That was 8 points above August and an even more solid 10 points above last September. So the rate cut came from the Fed at mid-month. So the strength that we're seeing in September draws from the anticipation of that first cut. We saw an increase in property listings, which, as we've talked about in previous podcasts, is fairly common after Labor Day. Sellers who were ready to list maybe over the summer, but then figured September was better than August for listing a property and drawing the attention that they'd like to it. And then we saw an uptick in appraisal and environmental activity, but it was less significant than what we saw with property listings. They were in the single digits. So that's likely work for deals and loans that were perhaps already in progress from the August months. So I think the October numbers will reflect any projects coming from the September uptick in listings that we saw. When I look ahead to the fourth quarter, I think our data will be an early indication of just how strong the market's reaction to this rate cut is and any rate cuts that maybe follow in November and December. Property listings will lead the charge, and then as more assets go on the selling block, the environmental and appraisal work in support of that first round of transactions will follow. Manus, I have to say I don't remember exactly what your forecast was, but I do recall that it was bullish. Do you know if it was above 98.2?
My guess is it was a little bit less. I'm going to say it was like 96 or 97, but I'm happy to be wrong in this case. I'm glad it surpassed even my bullish expectations. A couple of things about the numbers here, kind of just to boil it down to a couple of things. Some of this is a little bit repetitive. When you're talking about measuring the economic velocity of appraisals and phase ones, you're really looking at a leading indicator. This is before loans close, before property sales are reported, and it is a real leading indicator of the strength of the market. The contrast would be something like bank call reports where they talk about how much lending they've done in the previous quarter, or Fed flow of funds, things like that. Those have been the indicators people have used in the past. This particular indicator allows people to know before you start seeing it in public records data and so forth, that activity is picking up. That's one point I wanted to make. This is a really terrific indicator of the real pulse of CRE. The second thing I wanted to touch upon, which I thought was terrific, and I can't find the precise quote right now, but I wanted to bring it back. It's not just the data that we're seeing that is reflecting optimism, and it's not just our gut feel from the many listeners that we talk to each week. I saw an article written by Bloomberg. I think it was Natalie Wong that wrote it. And I heard you covered this last week. She had an interview with JLL, and one of their people said, all cylinders are firing right now for this market. Price discovery has taken place. Sales are ticking up. Buyers are coming to market. Sellers are getting the prices that they want. I think the term he used at the very end is, we're firing on all cylinders and we are entering a new period of liquidity for CRE. And of course, that's just one person's point of view, but it does feel that way, that things are all pointing in the right direction. And as long as this strike or, an oil shock don't really set us back, it does feel like we're setting up for a very nice quarter for CRE.
Martha did her best to channel you, Manus, last week. To the points that you just made, I heard very similar sentiments to the attendees that I talked to last week in Vancouver at the CRE Network convention. And I agree, I think we're on the cusp of a new chapter in commercial real estate. no matter who I talked to, whether they were a broker, an investor, a lender, a consultant, there was hope, and I heard optimism in voices that I haven't heard in a very long time. I think everybody's running out of ways to say cautious optimism, which we also talked about in the pod last week. CREFC just came out with their latest sentiment index this week. It rose to 121.1 in the third quarter, 18% increase over Q2, and the highest that lender sentiment has been since 2017, the highest in 7 years. So I think, that's how, I don't want to say desperate for optimism we are, but you definitely feel it. It's palpable. And Lisa Pendergast, who's CREFC's executive director, attributed that to lower rates, obviously, and an improving outlook. But I watched the headlines, and everybody's just assuming that rates went down once, they'll go down again in November and December. But I feel like we're still kind of tenuous based on a lot of things that you said earlier in this podcast, Manus. And I don't know, I have this voice in the back of my head telling me that November and December rate cuts aren't necessarily a given. If we start to see inflation tick back up, if we start to see kind of some dangerous red flags in the labor market, it might be too soon for Powell to run a victory lap. Am I wrong?
Well, he did give his hold your horses speech this week, which was settle down now, right? That's what my father used to always sell in the back seat. Settle down now back there. He said in the future, we're going to be data dependent. You shouldn't expect rate cuts as big as the one we saw in September. We may opt to be patient going forward. So I think that's his way of saying to the market, hold your horses. We may not see 50 basis points again between November and December collectively. So I think your point is spot on that's the case. But let's go back to those CREFC numbers for a minute. That's a little extraordinary to me. I have to say that I would have thought 2021 would have brought a higher number than 2017. I'm not so sure that I'm as optimistic that the market gets to where we were in 2021 now. I think I'm optimistic. I think we're going to see better numbers in October, November, December, but I don't think we're testing some of those exuberant sales levels and refinancing levels and other things we saw in 2021 anytime soon. So that surprised me that you have to go back 7 years to see a similar number from CREFC.
Yeah, agreed. I don't have their time series, so I can't compare 2017 to where it was at the market peak, but now I'm interested to go back and take a look.
Just to be completely blunt, where I think we're headed is we are going back by the end of the year to a new normal, which is the 2020, 2019, 2018 pace, which was healthy. Activity was marching along. It wasn't 2023 where things ground to a halt. But by no means am I expecting that 2021 rebound coming, nor do I expect office to participate in this rebound, at least in terms of property valuations. Yes, we'll see a lot of offices sell at deep discounts, but no, we're not going to see a rebound in valuations there. So I'm optimistic, but it's not exuberant. How's that?
I and a lot of our listeners would be happy to go back to 2019 based on what we saw in the past 2 years.
And it's also the wrap up of the quarter. So we're going to be doing our market snapshot reports for Q3, which provide a deeper dive across some of the activity index information. And so one of our did you know stats this week is derived from some of that, the top 5 metros outperforming the industry benchmark for environmental due diligence volume. Dianne, what are the top 5?
The top 5 are Minneapolis, Columbus, Atlanta, Pittsburgh, and Dallas. So those are 5 metros that had a volume of environmental due diligence that exceeded the industry benchmark in the third quarter compared to the third quarter of last year. And then I'll mention too, Martha, expanding that top 5 to the top 10. The key trend that I saw is that the Southeast region really figured prominently. So metros like Norfolk and Charlotte also joined the list, and Miami was on it as well.
So we'll wait to see the full report in the next 7 to 10 days when we'll be releasing that. So if you're interested in that, let us know. We'll be happy to send you a copy of that. Office leasing is making some gains in a number of cities like Boston and New York and others. And as we see those numbers unfold, it'll be interesting to see what that looks like nationwide.
Yes, we have seen some activity. It's been a pleasant surprise to see some of these 6-digit square foot leases come through. We seem to see about 3 or 4 now every week, whereas it seemed like for a while we were getting 3 or 4 a quarter. So activity is picking up. People are leaning in. Of course, everybody has probably seen by now several firms, including Amazon, have beckoned people back. They say it's a 5-day-a-week in the office situation these days going forward. That can only help. We've seen some cities where they've offered tax breaks to businesses that can guarantee that their employees will come back to the office 3 or 4 days a week. I know they did that, I believe, in San Francisco in July. I think they did it in San Francisco last week as well, giving people 2-year tax abatements for getting people to come back to the city and helping the cities become reinvigorated by people. These are very positive signs. I did see one really head-scratching number this week. I don't know if you guys saw the headlines or not, but they said that after San Francisco got, I think, about 1.7 million in new leases over the last 3 or 4 weeks, that their vacancy rate now has dipped, and it's now lower than Austin, Texas, which took me by surprise. I know Austin, a lot of retrenching there, Facebook giving back space, others pulling back from big tech expansions that took place over the last 10 years. But I never would have expected Austin to be anywhere near the same level of vacancy as San Francisco. I wouldn't have put them in the same decile even. So that took me by surprise.
For our listeners, if you missed the podcast last week, Candy Coleman was our guest speaker. She's our in-house leader of lender strategy and an expert. One thing that she said was she's also seeing that uptick in office leasing, Manus, that we've been talking about for quite a long time, but it's certainly picked up just in the past month or so. And, that perhaps from her perspective, she said office leasing is kind of the leading wave. It's improving vacancies, which you just mentioned, and certainly hopefully a sign of stabilization with some office assets, and that an uptick in transactions could follow that.
So we had a number of stories that we thought were noteworthy. We're going to start with the one out of Chicago area.
Yes, it's actually one firm, 2 leases, and it's great news for Chicago, which has been just, I don't know if it's the worst market, but it's among the bottom 5, I would say, in terms of loss of property value for offices and retrenchment of tenants cutting footprints by 50, 60%, right? The negative stories have been plentiful, but we got 2 here in the last 10 days, which have been great. Medline, which is a medical supply giant, signed two leases in the last 2 weeks in the Chicago MSA. One came about 10 days ago. It's been heavily reported. This was in Vornado's Merchandise Mart. The firm took another 100,000 square feet, which pushed their footprint in that property to over 300,000 square feet. That was a great expansion. Terrific news of a firm leaning in the Windy City. This week, the firm signed a second lease, this one for 210,000 square feet at 2375 Waterview Drive in Northbrook. The reporting there by Danny Ecker of Cranes. So a terrific double shot of leasing news in the Chicago MSA. Moving to a couple of others, fintech company Ramp signed a 132K square foot lease at 28/40 West 23rd Street. That's in the Chelsea neighborhood of Manhattan. The property is owned by Williams Equities, reporting there by commercial property executives Vincencio Fisua. I'm sorry if I pronounced that incorrectly. Also in Manhattan, Bridgewater Associates, the world's largest hedge fund manager, signed a 60,000 square foot lease at 295 5th Street. That comes from Steve Cuozzo of the New York Post. One more Manhattan story here. Retail luxury seller LVMH. And I have to be honest, I don't know precisely what they sell. I don't know if it's handbags or perfume, but I do know that they are a luxury retail giant. They signed a 150,000 square foot lease at 590 Madison Avenue. They're taking 4 floors at a 41-story building owned by the State Teachers Retirement System of Ohio. The firm also took a couple of weeks ago space at 550 Madison Avenue. So some good news there. Lastly, in the Bay Area, UC San Francisco is taking 300,000 square feet at a new building that's under development in an area of the city called Dogpatch. I'm not exactly sure where that is, but that comes on the heels of the 350,000 square foot lease signed by OpenAI in San Francisco just last week. So when we talk about momentum, that's really what we're talking about here. A couple different geographies, Chicago, San Francisco, New York, and several six-figure lease renewals or new leases. Good stuff.
Yeah, those are great. And those are real world examples of the trend that Candy had mentioned last week, Manus. On one of the stories that you highlighted, I wanted to jump on here was the LVMH one. Part of that story said that they inked a deal for 4 floors for a swing space. That aside from office space, they're considering leasing some retail space at the base of an office building. And it kind of harkened back to another comment that Candy said, which is, look, if you're out in the market and you've got an asset that starts with O, forget it. If you can somehow change it into a mixed use property, then it's going to be a lot better positioned. And last week in Vancouver at Crew Network, I sat in on an office breakout session, and there were a number of brokers from Dallas, and they said, there are essentially 10 or 11 major office buildings in Dallas for anybody who's looking for huge amounts of space, and that there are a number that have high vacancy rates. And what they're starting to do is look at just the top 4, 5 floors and making them into hotels or apartment buildings. And they're starting to redesign that space. They're designing separate elevators so that if you're going in to go to your office, you're in this elevator bank. And if you're going to get coffee or walk your French poodle in your pajamas, you take the other elevator. So it was kind of an interesting transition from office buildings into some kind of mixed use.
Diane, you mentioned French poodle, which I think is a perfect alignment to LVMH. Manus is a French holding company. Moet Hennessy and Louis Vuitton merged. So it is not surprising that you don't know them because they are about, 70 brands, luxury brands, Tiffany, Bulgari, Stella McCartney, Marc Jacobs, et cetera, et cetera. I'm sure you're not in the buying set of those type. Maybe you are. I don't know. You might be. I probably shouldn't brand you, but maybe you buy gifts for people that you love that are those types.
Sadly, and these people know it all too well, that just like I shop in the discount aisle of Kohl's to get my cheap khakis that I'm willing to wear for 20 years or more until they've completely frayed to nothing. A generous gift for me is probably a different definition than most other people, sadly, for those that I love. But I think that maybe I could identify 3 or 4 of those brands on the list of 70. I don't know. But I will throw one more comment in on that story, back to the commercial real estate angle of it all. And that is the asking rent for the 4 stories that they took was $190 a square foot. This was not your Class B, Class C, $60 a square foot with a lot of TIs and other kind of rent concessions. This was really high-end space they were taking, which makes it an even better story for that market. So good stuff.
Yeah, I'm curious what that means about the consumer economy. We can investigate that later. But Manus, the Kohl's thing, right on the money. I don't know if you listened to the end of last week's pod, but I called it. I know you have a bunch of sales transactions. Let's hit a couple of highlights before we close out today.
Yes, I wanted to start in the office space. We talk about how values have deteriorated considerably. You don't see really big sales taking place, but we did see a couple this week, including one which was really eye-popping. Love this one. In Miami, 701 Brickell Avenue sold for $450 million. That represents about $650 a square foot, a really nice price there. The buyer, Elliott Investment Management, the seller, Nuveen, who's big in the real estate space. They've been both active buyers and active sellers across a wide swath of property types over the last year. one of the biggest holders of real estate in the U.S. That story comes from The Real Deal. A couple of other not so positive stories in the office space in Sacramento. The Wells Fargo Center sold for $117 million, $234 a square foot. That's down 41% from the last sale in 2019. That's about the floor for, I hate to say it, for discounts, right? If you're getting something for 40% off, you're probably paying what is now a premium, because we've seen plenty of properties sell for 70 or 80% off. The buyer there was Buzz Oates. The seller was Manulife, who's been pruning their office holdings considerably. One last one in New York, 77 Water Street in Lower Manhattan, bought for $95 million. That was acquired for an office to residential conversion. The buyer there, the Van Barton Group, they're trying to put up a residential property with 600 units in Lower Manhattan.
Let's cover a couple more headlines, and I know you have them across multiple asset types, so let's hit the highlights there.
Yes, I'll pick one or two from each of multifamily, industrial, and retail. So let's start with retail. This was a biggie in Orlando. Waterford Lakes Town Center sold for $322 million, $330 a square foot. The buyer there, Kimco Realty, reporting by the Orlando Business Journal. This particular mall, we tend to have this vision of malls that is, they're down and out, they're Class B, they're Class C, 70% occupied, foot traffic is de minimis. This particular property, 13.6 million visitors per year. That's really something. A couple of other properties we have out there in the retail space. Site Centers was able to sell off 11 properties across the U.S. for a total of $600 million. That includes Hamilton Marketplace in New Jersey. That sold for $117 million, $240 a square foot. The buyer there was Benderson Development, if I remember correctly. Moving over to industrial, two big sales, a Sunbelt Logistics portfolio. This is properties in Georgia, Florida, and Texas, was acquired for $160 million, $89 a square foot by Northwood Investors. Also in the industrial space, EQT paid $140 million for USA Parkway Distribution Center in Sparks, Nevada. And I'll end with a multifamily story. This is in Wellington, Florida. The Quay at Wellington, which is a 350-unit property, sold for $144.2 million. This came with a loan assumption. The sale price equates to $412,000 per unit. Why did this one catch my attention? Largely because this property sold in 2018 for $120 million. So what you saw in the last 6 years there was $24 million, 20% appreciation of this asset over 6 years. The buyer there, Dermont, the seller, Stockbridge Capital, and reporting there by the South Business Journal, Brian Bandel, who I call the hardest working person in South Florida.
Normally, we have a funny kicker story that's somehow related to commercial real estate, but given the severity of the storm this past week and the fact that there is some real devastation going on there, I did want to give a shout out to a number of people who are a part of the search and rescue mission to find some of the people that are unaccounted for, people that are providing shelter, providing some assistance. They have no electricity, they have no water, they have no food. And it sounds like it's a pretty severe situation there, and they're getting a lot of people to send support and help. So a shout out to those people who are jumping in and trying to help.
It's the best of humanity during times like this. We're seeing it every single day. People looking out for each other, and God bless them. It's really a beautiful thing to see.
So with that, we'll close. Thanks to our producer, Josh Bruning. Join us every week as our Lightbox team shares CRE news and data in context. You can listen on any of your favorite podcast channels and send your questions or comments to podcasts@lightboxre.com. Thank you for listening and have a great week.
Let's go.